You've probably heard this a lot. The rich use debt to avoid tax. Robert Kiyosaki often say this.
Capitalists don't pay taxes.
And trust me, it might sometimes go right over your head. Does it make sense? How can the rich become richer? By using debt. Well, Kiyosaki often talks about how the rich use debt as a means of growing their wealth without triggering heavy tax burdens.
I'm in debt about $600 million. I love real estate, again, because it's debt. I use debt to buy real estate. And everybody else is saying get out of debt, right? I love debt.
Yeah.
Trump loves debt. He's a king of debt. And then this year I get tax breaks.
And he's not the only one. This concept is a cornerstone of wealth-building strategies for billionaires and millionaires alike. So how does it all work? It's not about borrowing money to buy a new car or upgrade your house. It's about using debt to fund investments, businesses, and even assets that actually put more money in your pocket and minimize your tax liability in the process. It's a game of strategy, one that the ultra-wealthy have mastered. Today we're going to break it all down and show you exactly how the rich use debt to grow their wealth, dodge taxes, and stay ahead of the game. Trust me, by the end of this, you'll look at debt in a whole new light. Understanding the basic concept: how debt reduces taxes. The main reason the wealthy use debt to avoid taxes comes down to how interest on debt is treated by the tax system. In most places, interest paid on things like business loans, mortgages, or other types of debt is seen as an expense. And the best part? It's tax deductible. This means that the interest they pay can be subtracted from their taxable income, which helps lower the total amount of income that gets taxed. Let's break it down with a simple example. Imagine a wealthy business person making $1 million from their company. If they don't use any debt, they're going to get taxed on the full $1 million. But what if they take out a loan for $500,000 at a 5% interest rate? That means they'd be paying $25,000 in interest every year. Here's how it works out. Without debt, they make $1 million in income. The government taxes them on the entire $1 million. With a 30% tax rate, they end up paying $300,000 in taxes. With debt, they still make $1 million, but now they're paying $25,000 in interest on that loan. So their taxable income drops to $975,000, which is the $1 million minus the $25,000 interest payment. With the same 30% tax rate, they only owe $292,500 in taxes. In this example, by paying $25,000 in interest, the wealthy individual reduced their taxable income to $975,000, which lowers their tax liability by $7,500. While this may seem like a small amount, when applied to larger sums, the tax savings can be substantial. The rich often use debt not just to reduce taxable income, but also to avoid paying capital gains taxes. Instead of selling appreciated assets such as stocks, real estate, or other investments, they borrow against them. This allows them to access cash without triggering capital gains tax, as no sale occurs. The interest on the loan is tax deductible. Let's consider the example of a wealthy individual, Mr. Rich, who owns $10 million worth of stock in a tech company. Over the years, the value of this stock has grown by 10%, meaning his $10 million stock is now worth $11 million. If Mr. Rich were to sell his stock, he would incur a capital gains tax on the $1 million profit. Selling the stock. Stock value at sale, $11 million. Capital gain, $1 million. Capital gains, tax rate, 20%. Taxes owed on capital gain, $1 million times 20% equals $200,000. However, Mr. Rich can borrow against his stock, using it as collateral. Let's say he borrows $5 million from a bank at an interest rate of 4%. The interest paid on the loan would be tax deductible, reducing his taxable income for that year. Borrowing against the stock. Loan amount, $5 million. Interest rate, 4%. Interest payment for the year, $5 million times 4% equals $200,000. Tax deduction for interest payment, $200,000. By borrowing against the stock, Mr. Rich avoids triggering capital gains tax because he never sold the asset. Instead, he borrows the money, paying only interest. The $200,000 interest payment can be deducted from his income, thus reducing his taxable income by that same amount. This strategy allows him to access liquidity without paying any capital gains taxes. While the interest on the loan will have to be paid each year, the total tax savings, especially when applied to large amounts, are substantial. If you look into the strategies of famous billionaires, things will make much sense to you. Take Elon Musk, for example. He uses stock-based loans to avoid capital gains taxes and reinvestment. Musk has famously borrowed against his Tesla stock to fund ventures rather than selling off shares, which would trigger capital gains taxes. This strategy allows Musk to avoid paying taxes on the appreciation of his stock while still having access to liquidity, cash, without selling his assets. Musk took out large loans against his Tesla stock in order to fund his ventures. By doing so, he avoided having to pay capital gains taxes on the growth of his holdings. The interest on the loans is deductible, which reduces his taxable income. This means Musk could borrow hundreds of millions of dollars without triggering a taxable event. Musk's strategy has faced scrutiny, especially because of his vast wealth and the optics of using stock-based loans to avoid taxes while maintaining control over Tesla. There are concerns about the sustainability of this debt, especially if Tesla's stock were to suddenly decline. Additionally, Musk's loans are often tied to high interest rates, which could eventually strain his finances if not properly managed. Despite these risks, Musk's ability to borrow against his stock has enabled him to maintain his control over Tesla and SpaceX, while avoiding paying taxes on large amounts of unrealized gains. While the strategy is effective in terms of tax avoidance, it does create potential long-term financial exposure, especially with the volatility of Tesla's stock price. Jeff Bezos uses debt for infrastructure development and tax deductions via depreciation. He used debt extensively in the early years of Amazon's expansion. By borrowing significant sums, Bezos was able to invest in Amazon's infrastructure, including warehouses, technology, and research and development. The interest paid on these loans was tax deductible, reducing Amazon's taxable income for years. Bezos also took advantage of depreciation. Depreciation allows businesses to deduct the cost of their assets over time, reducing the amount of taxable income. For a company like Amazon, which invested heavily in physical infrastructure, depreciation became a powerful tool in reducing taxes. Amazon's rapid expansion was partially funded through leveraged loans. As the company purchased expensive assets like warehouses, servers, and delivery infrastructure, Bezos utilized depreciation rules to further reduce Amazon's tax obligations. Instead of paying taxes on Amazon's rising profits, Bezos used the tax code's provisions on depreciation to offset those profits. Bezos has faced challenges with this debt-driven strategy in the sense that Amazon's aggressive use of debt has sometimes led to criticism over its lack of profitability in the early years. While Amazon was not making huge profits, it was consistently growing, and the debt helped fuel that growth. The strategy of using debt and depreciation also required a careful balancing act. Too much debt could have risked Amazon's financial stability, and the company needed to make sure its investments in infrastructure generated returns. However, this has not only been a tax strategy for Bezos, but also a business strategy, enabling Amazon to scale faster than it could have otherwise. Amazon's ability to reinvest its profits or borrow against future growth while minimizing taxes has been key to its rise. Donald Trump leverages real estate loans and tax deductions from interest payments. Donald Trump has used debt for decades in his real estate ventures. Trump's organization has taken on significant loans using mortgages and other financing to buy properties, develop them, and expand the business. The interest payments on these loans are tax deductible, which allows him to reduce his taxable income year after year. Trump's real estate deals are often financed with a combination of debt and equity. By using leverage, debt, Trump is able to control large assets without having to tie up all his personal capital. The key benefit, of course, is the tax deductibility of interest payments on the debt, which reduces the overall tax burden. Trump's acquisition of properties like the Trump Tower in New York was financed largely through debt. He could borrow money from banks and use the interest payments as a deduction, thereby lowering the taxes owed on his income. Additionally, the Trump organization often takes advantage of accelerated depreciation, allowing the company to reduce taxable income further. Trump's use of debt has faced significant complications over the years. The Trump organization has been scrutinized for its debt levels, especially during periods when the real estate market has struggled. The Trump organization's reliance on debt left it vulnerable during the 2008 financial crisis, leading to challenges in securing financing. Trump's debt strategy has also drawn criticism for pushing financial risk to the brink. Furthermore, Trump's businesses have faced scrutiny from tax authorities.
12 years or something like that. Every year they audit me. I will absolutely give my return, but I'm being audited now for 2 or 3 years, so I can't do it until the audit is finished, obviously. You never give a tax return when you're being audited. Do you know I get audited every single year? But I can't release tax returns when there's an audit. Because it's under audit. I'll release them when the audit's completed. Nobody would release when it's under audit. I've had audits for 15 or 16 years. Every year I have a routine audit. Under audit, when the audit's complete, I'll release them. Almost every lawyer says you don't release your returns until the audit's complete. When the audit's complete, I'll do it. Well, I'm not releasing the tax returns because, as you know, they're under audit.
His tax returns and loans have been under investigation multiple times, and the 2020 New York Times report highlighted that Trump paid minimal taxes during certain years by taking advantage of deductions linked to his business expenses, including interest on debt. Despite these complications, Trump's ability to use debt and the tax benefits of interest payments has allowed him to amass a fortune in real estate while minimizing his personal tax burden. Warren Buffett uses insurance float and debt financing for investment growth. Warren Buffett, often called the Oracle of Omaha, uses insurance float and debt financing for investment growth, which is a somewhat unique way compared to other billionaires. Through his investment company Berkshire Hathaway, Buffett has made significant use of insurance float, the money held by insurance companies before claims are paid out. This float can be used as a form of debt because Berkshire can use it to make investments without immediately paying back the money. Additionally, Buffett utilizes debt in many of his acquisitions to finance deals. For example, Buffett's acquisition of Burlington Northern Santa Fe, BNSF, in 2009 was partially financed by debt. Berkshire Hathaway issued bonds to fund the deal, taking advantage of low interest rates and the tax deductibility of interest payments. The debt allowed Buffett to acquire BNSF without needing to use large amounts of Berkshire's equity, minimizing tax liabilities in the process. Buffett's strategy of using debt in acquisitions is a combination of leveraged buyouts and tax-efficient financing. The use of low-interest loans allows Berkshire Hathaway to amplify the returns on investments while deducting the interest payments. Buffett's use of debt has been highly strategic, but it's not without risks. The large amounts of debt involved in some of Berkshire's acquisitions could potentially magnify losses if the investments do not perform as expected. However, Buffett is known for his conservative use of debt, and his track record of investing in companies with stable cash flows has helped mitigate risks. Still, his use of debt is scrutinized, especially when it comes to larger deals. Buffett's critics often point out that while the tax advantages of debt are clear, excessive borrowing can also make a company more vulnerable in times of economic downturn. The challenges of using debt for tax avoidance. Using debt to avoid taxes may sound like a smart strategy, and for many wealthy individuals, it's been incredibly effective. But like anything in finance, it's not without its risks and challenges. Let's break down what could go wrong when you use debt to minimize your tax bill and explore some real-world examples of how it can backfire. 1. Financial instability and over-leverage risk. When you borrow a lot of money to avoid paying taxes, you're creating an obligation to pay it back. And if things don't go as planned, it can really hurt your financial situation. The more you borrow, the more vulnerable you are if things take a turn for the worse, whether it's a downturn in the market, a bad investment, or a dip in revenue. Take Jeff Bezos, for example. In Amazon's early days, Bezos used debt to fund the company's rapid growth. That helped him avoid taxes by reducing taxable profits. But what if Amazon hadn't taken off the way it did? If the company had failed, Bezos would have been stuck with huge debt payments, possibly leading to bankruptcy or having to sell off valuable assets to cover those loans. More recently, Elon Musk is a prime example of this risk. Musk has used stock-based loans, borrowing against his Tesla shares, to avoid paying taxes on his income. However, Tesla's stock is volatile, and if it suddenly dropped, Musk would have to pay back those loans, potentially through the sale of his shares. This could trigger a capital gains tax, the very tax he's trying to avoid, and he could end up losing a lot of his wealth if things go sideways. 2. Scrutiny from tax authorities and legal challenges. As these strategies become more common, tax authorities are paying closer attention. Governments are always on the lookout for loopholes that allow people and corporations to avoid taxes, and they're increasingly challenging aggressive debt-based tax strategies. Let's talk about Donald Trump for a moment. In 2020, the New York Times revealed that Trump paid just $750 in federal income taxes in the year he became president. It turned out that much of this tax avoidance came from using real estate loans and depreciation deductions. However, this didn't go unnoticed. Investigations and audits followed. If tax authorities decided these deductions weren't legitimate, Trump could have faced penalties, back taxes, and possibly even lawsuits. Similarly, Elon Musk's use of stock loans could come under increased scrutiny. In 2017, the IRS started cracking down on stock loans, questioning whether they were being used to avoid paying taxes on capital gains. Although Musk hasn't been directly hit yet, the increasing focus on such tactics means there's always a chance the tax authorities could target him. This could result in serious legal challenges if the IRS deems the strategy improper. 3rd, public perception and reputation risks. Even if it's entirely legal, using debt to avoid taxes can generate some really negative public attention. The optics are tough, especially when high-profile figures and large corporations avoid paying taxes while benefiting from public services and infrastructure. The public doesn't always see the fine print. They see wealthy people getting away with paying less than their fair share. Take Amazon and Jeff Bezos again. When news broke that Amazon was paying little to no taxes despite its massive profits, it sparked major backlash. Critics argued that Amazon wasn't contributing its fair share to the economy, even though it was benefiting from government-funded infrastructure. This didn't stop Amazon's growth, but it certainly damaged the company's public image and led to calls for higher corporate taxes on big companies. For someone like Elon Musk, constantly in the spotlight, his use of debt to avoid taxes has invited similar criticism. While many people admire his achievements, others view his tax avoidance tactics as a sign that he's out of touch with the average person. That kind of backlash can hurt a business or personal brand in the long run, especially if it leads to a perception that someone is exploiting the system. 4. Changing tax laws and regulatory risks. One of the biggest risks with using debt for tax avoidance is that tax laws can change. Governments aren't blind to the strategies that the wealthy use to minimise their tax burden, and they are actively working to close these loopholes. A tactic that works today might not be legal or effective tomorrow. Consider Trump's use of real estate depreciation. In 2017, the Tax Cuts and Jobs Act was passed, limiting some of the deductions Trump had relied on for years. This change put his tax strategy at risk and forced him to rethink how he handled real estate investments. What worked in the past wasn't guaranteed to work in the future, and that's a huge risk when you're depending on debt to avoid taxes. Similarly, Musk's stock-based loans could face tougher regulations. There's talk about lawmakers cracking down on how stock is used as collateral for loans to avoid capital gains taxes. If those laws change, Musk might find himself paying taxes on money he hasn't actually received, which would completely undermine the point of using these loans in the first place. In fact, government intervention in the form of new tax rules could make these strategies much less effective or even illegal. 5. Potential for debt default. If things don't go as planned, over-leveraging yourself can result in defaulting on your loans. This might happen if your business doesn't generate enough income to cover your debt payments, or if an investment doesn't pay off. Defaulting on debt could lead to a liquidation of assets, and in the worst-case scenario, bankruptcy. Consider a company like Berkshire Hathaway, which is led by Warren Buffett. While Buffett is known for being conservative with debt, imagine if the company had over-leveraged itself in a risky acquisition. If the market had turned against them, Berkshire Hathaway could have faced a situation where it couldn't service its debt, potentially leading to asset sales or even bankruptcy. This is a risk that any business faces when it takes on large amounts of debt, particularly for the purpose of tax avoidance. The same is true for Musk and his stock loans. If Tesla's stock drops suddenly, Musk could face a margin call from the lender. In other words, the lender might demand that he pay off the loan immediately, forcing him to sell Tesla shares. This could lead to huge taxable gains, which would defeat the purpose of using debt to avoid taxes in the first place. So, what should you do? Now, if you're considering using debt to reduce your tax bill, you might be wondering, is it worth the risk? The truth is, it can work well for some, but it's not a one-size-fits-all solution, and it definitely requires careful consideration. First, ensure you have a clear strategy for how the debt will fit into your overall financial plan. Don't just rely on it to escape taxes. Ensure that your investments and business ventures are sound enough to manage the debt over the long term. Second, be prepared for potential changes in tax laws. Governments are becoming more aware of these tactics, and they could make changes that affect the effectiveness of debt-based tax avoidance. Stay informed and adapt as needed. Third, think about your public image and reputation. If you're a high-profile individual or business, remember that your actions will be scrutinized. While using debt legally is fine, constantly being in the spotlight for tax avoidance might damage your reputation in the eyes of the public or investors. Finally, don't over-leverage. It can be tempting to borrow large sums to avoid taxes, but remember that too much debt can be risky. If things go wrong, you could end up in a much worse situation. In conclusion, using debt for tax avoidance can work, but it's not a tactic to dive into without careful planning and consideration. It's important to weigh the potential benefits against the risks and consult with financial and legal advisors before making decisions. The key is to use it wisely, not recklessly, so that you're not left facing unexpected challenges down the line.